Namaste. We have already covered policy guidelines for credit risk and also discussed the first two shocks in our earlier sessions. Now we move to the third of 9 credit shocks. This one focuses on NPA shocks to test balance sheet resilience. Stress tests in this context highlight vulnerabilities in provisions and capital adequacy. Objective: increase NPAs in 4 key sectors: agriculture, power, real estate, telecom, roads. Goal: test if provisions and capital remain adequate under stress. Guideline: net NPA increases by 3%, baseline, and 5%, medium. During downturn, banks must keep provisions at the higher of prevailing or regulatory levels. Data inputs required: outstanding exposures, gross NPAs, provisions, RWA, net NPAs. These form the base for scenario calculations. Approach: use Python solver to simulate asset quality shift. Standard right-pointing arrow substandard migration is modeled. Provisions are updated, and net NPA is recomputed to match target stress. Solver logic: define function that reduces standard, increases substandard, recalculates provisions, and solves for net NPA target. Constraint: cannot shift more than available standard pool. Manage RWA. Recalc based on provision coverage. Coverage greater than 50% right pointing arrow RW equals 50%. Coverage greater than 20% right pointing arrow RW equals 100%. Else RW equals 150%. Formula: RWA equals RW times outstanding provision. Build scenarios. Call solver for baseline, plus 3% NPA, and medium, plus 5% NPA. Compute impact on capital equals change in total RWA times 11.5%. Compute impact on P&L equals change in provisions. Control parameters: highly customizable in Python. Stress settings can be stored in a dictionary, looped over, and results saved for baseline and medium scenarios. Illustrative output: baseline shows modest capital, P&L impact. Medium scenario shows sharper erosion. Conclusion: approach works with existing data, flexible for new shocks, and scalable for regulatory stress testing. We will cover remaining in our upcoming videos. Like, share and subscribe for wider reach.